Hello everyone, I am Professor Suyog Sajad. We are going to discuss today about mutual funds. So first understand what is mutual fund. So mutual fund is basically a pool of money. This money is basically collected from various investors. Maybe they are small investors or institutional investors. And this money is professionally managed by fund managers on the basis of different objectives. These objectives might be a regular income generating or maybe a wealth creation. So on the basis of investment objectives, different types of securities are selected, like stocks, bonds, money market instruments. So basically, on the requirement of the investors or the need of the investors, the different types of schemes are developed. Now, some of the schemes are investing only into stocks or shares, or some of the schemes they are only investing into bonds or money market instruments, or some of the instruments or some of the schemes they are investing into a combination. So some part into stocks, some part into bonds. Okay, so we have a hybrid types of schemes also. So all these schemes are designed by the fund managers. They are depends on the objectives of the investment. So it may be a short term, mid term, or long term objective, or maybe a low risk, mid risk, and high risk, or maybe a regular income generation or a wealth creation. So depends on different objectives, the schemes are designed. Now these mutual fund schemes are nothing but a portfolios of different types of assets. Now assets means like stocks, bonds, or money market. So in India, we have a structure of mutual fund industry or any mutual fund scheme is basically launched by the AMC. AMC stands for Asset Management Companies. So there is a huge structure. Like whenever a company starts, there is a sponsor or promoters. So in mutual fund, there is a sponsor who is acting as a promoter. So sponsor can be a bank or can be a big institute. They appoint a trustee, okay, or trustee company. Now this trustee company further appoints AMC and a custodian. Now AMC stands for Asset Management Company. Like you can say the HDFC Mutual Fund or Axis Mutual Fund or ICICI Prudential Mutual Funds. So these are the AMCs. Now the trustee is also appointing the custodian. Now the role of the custodian is to safeguard or basically to keep a record of the securities purchased by AMC. Security stands for stocks, bonds, or various instruments bought by AMC. So custodian will keep a track of this instrument and they hold this security. So here you can say the amount basically invested by AMC and they are purchasing the stocks or bonds, but they are not held with the AMC. They are with custodian. So there is a checkpoint. Okay, that's why they work together. And also AMC can appoint RTA. RTA stands for registrars and transfer agents. Now these RTAs are basically doing all clerical work. Now in India, there are two major RTAs for mutual fund industry. The first is CAMS, CAMS, that is Computer Application, and second is the Carving. Okay, so these two companies, CAMS and Carvey, are acting as RTAs. They are doing all clerical work, doing all data gathering activities or redemption and purchase processes. So they are basically a support function to the AMC. So investors can directly connect to the AMC or they can connect through these RTAs. So this is the structure of Axis Mutual Fund. Here you can see the mutual fund is named as Axis Mutual Fund. However, the sponsor is Axis Bank. Trustee is Axis Mutual Fund Trustee Limited. You can also see the custodian. The custodians are Deutsche Bank and the Bank of Nova Scotia. Registrar or Cartwheel Computer Share. So this is how this Axis Mutual Fund having a structure. They are operating in this manner. Okay, like you can see in this, there's a sponsors, trustee, custodian, AMC, and RTA. Now in this case, AMC is basically Axis Mutual Fund. Now some of the keywords in mutual fund that you should know. So units. So as when we trade into shares, we are basically buying or selling number of shares. So here in mutual fund, we don't call them as shares. We call them as units. So how many number of units we are buying or selling in mutual funds? That is important. The second is the face value. Every share has a face value. Similarly, in mutual fund, the units of mutual fund also have a face value. Generally, this face value is of 10 rupees. Then a unit capital. A unit capital is nothing but the number of units issued multiplied with the face value. For example, let's say a particular mutual fund scheme have issued 1 lakh units and the face value of each unit is 10 lakh, 10 rupees per unit. Then the unit capital is 1 lakh into 10. So that is 10 lakh rupees is the unit capital. Then we have a recurring expenses. As you say, you actually see in share buying and selling, we have to pay some brokerage, some charges or some taxes. So altogether, we are spending certain expenses whenever we are buying or selling the shares. Similarly, in mutual funds, whenever we are investing or redeeming, there are certain charges. Okay, or basically these recurring expenses comprises of some money management fees or fund management charges, uh, fund managers charges, some fees like auditing or commission. So various fees are basically considered and collect or basically they group together and called as recurring expenses. Then there's a net asset value. Net asset value is nothing but the price of the mutual fund unit or market price of the mutual fund unit, which is generally declared at the end of the every working day. Okay, so like in shares, we can buy or sell the shares at the current market price. But mutual fund NAVs, the value is declared only at the end of the day. So even if you purchase uh, the mutual fund today, so you will get a today evening NAV. Okay, not the before day before NAV. Okay. Then there is one more term is asset under management. Now, asset under management is also called as AUM, the short form. So how much amount is basically the current market price of the mutual fund scheme. Okay, it is not a how much amount is invested. It is the amount or the current market price of the total investment in that particular scheme. And then mark to market. Mark to market is basically every day, as I've telling you, the NAV is declared. So amount of money invested in mutual fund and the current market price. Of course, there is a difference. Okay, so mark to market is basically marking how much amount is or the current present value of the mutual fund. Okay, so this is a process mark to market to arrive at a asset under management or to arrive at a net asset value. Now, what are the advantages of the mutual funds? As these funds or mutual funds are basically managed by professionals, we generally call them fund managers. So every scheme is managed by one or more fund managers, as well as one fund manager can manage more than one scheme. In mutual funds, we always say it's a affordable portfolio divergence. So first of all, affordable because we can invest a small amount in mutual funds. Even we can start with 100 rupees. Okay. Also the portfolio divergence because we are investing into different asset classes also within the asset classes. Like in equity shares, we can invest into banking shares, we can invest into FMCG shares or many other shares. Okay. So in mutual fund scheme, in a particular scheme, we can invest more than 40 to 50 stocks. So we can have an exposure of more than 40 to 50 stocks or 50 to 50 securities in one single scheme. Now, economies of scale means we can basically invest from very small amount to a large amount. We have various options available. Second, the transparency. Whenever you invest into mutual funds, you will know in which type of asset classes, in which type of securities you are going to invest. So there is a complete transparency. Apart from that, what are the different charges you have to pay, or what kind of taxes you need to pay? So there is a complete transparency in mutual fund, except the returns. You will get to know about what are the underlying assets or in which types of securities you are going to invest, what are the charges applicable, what are the taxes applicable, what is the risk associated with the scheme. But only thing, you cannot predict the returns. Okay, because returns are subject to market. Then the liquidity. Most of these schemes are liquid. Liquid means you can withdraw at any point of time. Okay, so that's why the liquidity you will get in most of the schemes. Then we have a tax deferral and tax benefits. Because in mutual funds, unless until you are not withdrawing the funds, you are not liable to pay any taxes. But once you withdraw the funds are liable to long-term as well as short-term tax again. Okay. And convenient options like SIPs, systematic investment plan, systematic withdrawal plans, lump sum investment, or systematic transfer plan. So you have a various investment options available, so that as per your convenience, you can choose the appropriate option for you. And a regulatory confirm that a SEBI, Security Exchange Board of India, is acting as a regulator for the mutual fund industry, along with the AMFI, Association of Mutual Fund in India. So these both the entities are acting as a regulatory bodies for mutual fund. So that's why there is a strong regulation, and the chances of frauds are very, very less. So that's why the mutual funds are one of the secured investment we can consider. Only thing, the returns are not uh, guaranteed. Okay, they are subject to market. Now the limitations. So lack of portfolio customization. See, as these funds are managed by the dedicated fund managers, and the portfolio is run by these fund managers. So as an individual, we cannot ask them for customization. Like they can keep some of the stocks like from banking, or like it is up to the fund manager. The investors cannot uh, suggest any type of stocks or any type of changes in the portfolio. So that's why we can say that there is a lack of customization. The second is choice overload. As in India right now, 45 plus AMCs are working, and 45 AMCs having at least 40 funds with each. So you can say around there are 1600 to 2000 schemes available, and it is difficult to select which one is suitable for you. So that's why most of the time you require a dedicated advisor to select the proper scheme as per your requirement and need. Again, there is no control over the cost, as we have discussed about the recurring expenses. The cost is not in our hand. All the things are managed by the AMCs, and no guaranteed return. Yes, so all the mutual fund schemes, they are not offering any guaranteed returns. Okay, sometimes in equity you may get a negative returns, but over the long term period, you will get an average return of 8 to 12%. So mutual fund schemes are classified on the basis of either on the structure of the funds or on the management of the portfolio and on the universe of the investment. Now the first type or first classification is on the basis of the structure of the funds. So here three types of funds are available, like open-ended funds, closed-ended funds, and interval funds. Now the open-ended funds are like a savings account. That is, once they open or once they launch, you as an investor, you can enter or exit multiple times. Okay. Second is close-ended funds. Close-ended funds are like fixed deposits. It has a starting point, a fixed starting point, and a fixed maturity point. Okay. So generally close-ended funds, you can enter only at the entry point and only at the, you can exit only at the maturity point. You cannot enter or exit in between. Okay. They are like a fixed deposits. Whereas open-ended are like a savings account. You can enter or exit multiple times. Now the third category is interval funds. The interval funds are like a combination of open-ended and close-ended. Because once, see, in interval funds, once the scheme is started, it will get locked for certain period. Let's say a 6 month. There is a lock-in period of 6 months. After 6 months, there will be a window of 15 days. Now in this window period, you can enter again or you can exit. It's up to you. If you want to exit, you can exit. If you want to enter, you can enter. But again, after 15 days, the window get blocked and the fund is get locked for next 6 months. Okay, so this system gets repeated. So that's why the internal funds are basically continued like a open-ended, but again it has certain window period where you can enter or exit. Okay. Now the second types of category is management of portfolio. So the funds, all the funds are basically managed by dedicated fund managers. But again, these funds are categorized into two, like actively managed funds and passively managed funds. The first is actively managed funds are basically the funds are basically designed by the dedicated fund managers on the basis of the different objectives. And these the stocks or underlying assets are frequently churned to achieve or to optimize the returns. Okay, so they are continuously monitored, actively managed, continuously they are churned. Okay, so these four folios or these schemes are basically actively managed funds. Whereas passive funds, these funds are rarely churn. Okay, rarely or once a year they can churn, or they are basically following some external portfolios like Nifty. Like as you know, in Nifty there are 50 stocks. So let's say a Nifty index fund will be having a 50 stocks which are belongs to the Nifty 50 portfolio. Okay, or BSE 30. So we have a various indices portfolios which are basically passive funds. Then there is a third categories on the basis of the investment avenues or investment universe. So different types of asset classes, especially equity and debt. So we have a dedicated equity fund. So equity fund basically they are investing into only equity stocks. We have a dedicated debt funds in which the fund is basically investing into bonds, debentures, or sometimes into money market instruments. We have a third category as hybrid funds. This is a combination of equity and debt. Again, we have an aggressive hybrid fund, conservative hybrid fund, or moderate hybrid funds. So basically, on the basis of the weightage given to the equity and debt, we can decide. So aggressive hybrid funds where the weightage given to equity is more than 60. The same time, the conservative, the weightage given to debt is more than 60%. Okay. Then we also have a solution-oriented funds and some other category funds. So let's discuss one by one these five types of schemes. So before understanding, we should understand what is a large cap, mid cap, and small cap. So how to identify the stocks, whether it is a large or small or mid cap. To understand this, we need to first know what is market cap or market capitalization. Market capitalization is nothing but the number of shares issued the market multiply with the current market price. For example, if the Reliance have issued 1 lakh shares in the market and the current price of each share is let's say 100 rupees. So 1 lakh into 100 is basically your market cap. So when we arrange all the listed company shares as per their market cap in a descending order, means the company who is having a highest market cap will be at the top. Okay, so if we arrange them in a descending order as per the market cap, the first 100 companies are considered as large cap. Next 150 companies, that is from 101 to 250 company, we call them a mid cap, and the rest all the companies are called as small cap. Okay, so this is a definition for large cap, mid cap, and small cap. Now the equity schemes. So we have 10 different types of equity schemes based on the market cap, sector, and various themes. So let's consider the first. It's a multi-cap fund. Now multi says that this particular scheme is having all the types of companies like large cap, mid cap, and small cap. Then there is a dedicated scheme of large cap fund, large cap and mid cap fund, and mid cap and small cap. So on the basis of market cap, we have these five types of schemes. Then we have a dividend yield fund. As you know, some of the stocks or shares they give dividend regularly. So if we create a portfolio of such stock, we can give them name as a dividend yield fund. Then we have a value fund. Value fund is basically when the fund managers identify such companies which can create a value in long term. So let's say we can say on the basis of the fundamental analysis, if we find some of the companies they are undervalued and in long run they can be the best investment. So if we group together all these companies or we create a portfolio of such companies, we call such funds as a value fund. For example, ICICI Discovery Value Discovery Fund. Okay. Then we have a contra fund. Contra fund is again entirely different objectives. Like contra is basically contrarian view. Okay. So let's say if everyone is selling a particular company share, in that case, the fund manager decide to buy those shares. Okay. Like the market view for particular share is sale, but the fund managers are basically buying these shares. So they are taking an opposite action to the market sentiment. And that's why it is a contra fund because the fund is based on the contrarian view. If all the market is going for the selling, but the fund manager is going for the buying. Okay, so opposite view, but that's what is called as contra fund. For example, SBI contra fund is the example. Okay, then the focus fund. Focus funds are basically dedicated funds focusing on limited stocks, around 20 stocks, 25 stocks, sometimes 35 stocks. So for example, Axis 25 focus fund and Motilal Oswal 35 focus fund. Then again, we have a category on the basis of sectors and themes. Now, as you see in industry, we have a different sectors like banking sector, financial services sector, FMCG, automobile, and so on. So we can create a portfolios of each sector, and that's why these schemes are called as sectoral schemes. Sectoral schemes are highest risky schemes because they are basically pertaining to a particular sector and the fund is not well diversified. Then we have a thematic funds. Now these thematic funds are based on certain themes like ESG or it can be a healthcare, it can be a some on green energy. Okay, so the companies related to particular theme they are basically grouped together. They might be from different sectors, different areas or industries, but they are based on or connected through a particular theme. And the last we have a equity linked saving scheme, which is basically investing into equity. But for this particular scheme, you will get a tax deduction under section 80C up to rupees 1.5 lakhs. Now we have a 16 types of the debt schemes, starting from overnight funds to floater funds. So we can first consider from overnight to long duration funds. So first 9 schemes are based on maturity of the instruments. Okay, so like overnight funds, they invest into call money market. Liquid funds, they are also investing into call money market, plus some treasury bills of short duration or commercial papers. Ultra short duration funds, again, the investment or the maturity period is up to 3 months to 6 months. Low duration, again, 6 months to 9 months or up to 1 year maximum. Similarly, a money market fund, they are investing into treasury market, treasury funds or commercial papers or certificate deposits. Again, the maturity of these schemes or maturity of the underlying assets are basically less than 1 year. Now we are shifting to the short duration. The short duration is basically up to 3 years. Okay, so in up to 3 years funds, the amount is invested into debentures or the bonds which are going to mature in next 2 years or 3 years. Then the medium duration up to 5 years or up to 7 years, basically 3 to 7 years. And medium to long term is up to 7 to 10 years, and long duration is up to more than 10 years. So all the underlying instruments or underlying assets having a maturity of different period, like up to 3 years, then we are going for short duration, 3 to 7 years, we are going for medium duration, or 7 to 10 years, we are going for medium to long, and so on. So first nine schemes are basically investing into money market and bonds, debentures, depends on their maturity period. Then the dynamic bond is basically the scheme which are investing as per the market, okay, or as per the market condition. They are basically switching this underlying portfolio, okay, as per the market condition. Then there is a dedicated corporate bond fund where the investment is going only into the corporate bonds. They are not investing into any public sector undertaking or any government bonds. The credit risk fund is again the riskiest fund among all the debt scheme category, because they are investing only into those bonds or the securities which are having a chances of default. Okay, which are having a higher chances of default. So that's why this is a credit risk fund, and they are risky. They are basically investing into masala bonds, but the risk is very high. Next slide is banking and PSU fund. So dedicated fund where they are investing into only banking and PSU securities, debt securities like bonds, debentures. Okay. Guild fund is basically dedicated to the government security only. Guild is basically government securities. So guild fund dedicatedly invests into government securities like government bonds, treasury bills, or any other instruments issued by the government. And last is floater fund. A floater fund, the underlying investments or the, we can say, the bonds or debentures, which are basically floating bonds. So their rate of interest is not fixed. This rate of interest, or we generally say the coupon rate, is flexible as per the market, or it is basically linked with some external benchmarks. So when we group all the floater bonds in one portfolio, we called it as a floater fund. Then there are some other category schemes like hybrid. Hybrid schemes are basically combination of equity and debt. So we have a conservative hybrid fund where the debt portion or the weightage given to the debt folio is more than 60%. We also have a balance scheme where we can have a 50-50%. We also have an aggressive where equity portfolio is more than 60%. We can also have a dynamic asset allocation. So in dynamic asset allocation, the different types of assets are considered, even the gold, equity, debt, and this asset allocation is changing as per the market. So if you see that if we think the stock market is at peak, so in this case, the stock market is basically we are withdrawing from the stock and we are uh, investing that amount into debt side. Okay, so it's as per the market. The market, which types of market is currently going up or it is going down. Okay. So if the stocks are going up, so sometimes we say that if the stocks are going up, then gold will come down. So we can take opposite action. So we can give more weightage to the stocks and less weightage to the gold. Now multi-asset allocation, we are investing into again different types of asset classes. Arbitrage funds is basically low risk funds, though they are investing directly into equity, but because of the arbitrage, they are getting a definite profit. So these funds never be in losses. Okay, so those who wants to get a lower returns, but again the uh, positive returns, so they can invest into arbitrage funds. And last is the equity savings funds. Now these equity savings funds are basically investing into equity, but again their returns are very low. Okay. They're not up to the mark. They're generating 6 to 7% returns, even though they are investing into equity. Again, this is the kind of a hybrid scheme where the more weightage given to the debt as well as equity. Now there are solution-oriented funds like retirement funds and children's funds. Now both these funds are having a lock-in period of 5 years, but you will not get any tax benefit for this lock-in period. Some other schemes like index funds or exchange traded funds, even fund of funds. In index funds, as there are various indices like Nifty, Bank Nifty or Nifty IT or BSE. So these are basically indices are nothing but a portfolio. Now, if we consider a portfolio on the basis of the underlying assets of these indices, so we can give them a name. For example, let's say if I create a fund which is having a securities exactly similar or exactly same as per the Nifty. Okay. So 50 stocks of Nifty, if I'm creating a portfolio, that is basically index fund. Some of these special schemes like fixed maturity plan, where they are basically closed-ended funds because the maturity is fixed. They're like a fixed deposit that we have a specific maturity, but we are not having any specific or guaranteed gains. Okay. Then we have a capital protection funds. They are also a category of fixed maturity plan because they are also closed-ended funds. But in capital protection funds, you have a capital protection, means whatever amount you have invested, you will get the guarantee that your capital is 100% secure. Now, infrastructure debt funds, they are investing into, this is basically a thematic kind of fund where the funds are investing into infrastructure companies' debt securities. We also have a real estate mutual funds where funds are not directly invested into real estate, but they are invested into the companies who are dealing into real estate. Similarly, some smart beta funds, quant funds. Quant funds are basically on the basis of the statistics of the the call are basically the securities are selected on the basis of the statistics like standard deviation, beta, or some quantitative techniques. The stocks are selected. Okay. So these are the various schemes under mutual funds. So whenever these schemes are launched first time in the market, as like whenever the stocks are launched by the companies, they launch in the process of IPO, initial public offering. Similarly, the mutual fund schemes are launched in NFO. NFO stands for new fund offering, okay, or new fund offer. So all the mutual fund schemes they launch in NFO. So whenever they launch, they also launch with some documents. Now these documents contain the various types of scheme related information, some additional statements related to scheme, what kind of the asset classes in which the fund is going to invest, what is the objective of the scheme, and yeah, many more things basically relevant to the scheme is given. Now these are the three documents which are always related to the scheme. Okay, just like in equity share or in IPO, there's a red herring prospectus. So similarly, whenever the NFO scheme launches, you will get SID and ACI. So SID is basically scheme information document and ACI is statement of additional information. So these two documents are get published when NFO launches. The key information memorandum is again additional document which contains most of the schemes, existing schemes information along with some application forms. There is one more document published every month called as fact sheet. The fact sheet gives the past performance of all the schemes available or existing for that particular AMC. So every AMC launches their own fact sheet every month. Now for previous month's fact sheet is available on the 15th, roughly on the 15th of the month. For example, it's a January month's fact sheet will be available on 15th of February, which is giving you data up to 31st of January. Okay. So every month the fact sheet is released or published, and you will get all the information about different types of schemes, about the risk, returns, who is the fund manager, what is the portfolio size or AUM, then inception, past few years return like 1 year return, 3 year return, 5 year return, 10 year return, 15 year return, or since inception returns. Even the returns on lump sum investment, returns on SIP investment. Again, if the scheme is declaring the dividend, then what amount of dividend they have declared, You will get lots of information about the fact sheet along with the performance parameters like standard deviation or beta, Sharpe ratios, recurring expenses or TR total expense ratios, even different types of loads, exit loads, entry loads. Okay, so various information is available on fact sheet. So if you want to know about each scheme, you must go through all these documents to understand scheme very well. Then the schemes are categorized on the basis of the risk. Now this there is a riskometer, 6 scale riskometer. The scale is starting from low to very high. Okay, so depends on the types of scheme. The riskometer is giving you the proper scale. Okay, just for example, the overnight and liquid funds having a very low level, whereas other type of schemes like equity schemes will always have the high scale. Some of the debt scheme you will find at moderate or moderately high. Yeah. It depends on the scheme type and underlying asset. You will find a different types of risk. Okay. Now there are investment modes in mutual funds that you can invest through different style. So first is lump sum. So lump sum is nothing but when we invest into fixed deposit, we give a lump sum amount. Okay, like let's say when you open a 10,000 rupees fixed deposit, so your fund will get invested into fixed deposit for let's say a 1 year. So similarly in mutual fund, if you invest a lump sum amount, so you have a lump sum investment option. Second, a SIP. If you want to invest into a periodical manner, like recurring deposits, like every month you have to invest 1,000 rupees, 2,000 rupees, and so on. So you can go for the SIP, that is systematic investment plan. In both the cases, lump sum and SIP, the fund is getting debited from your bank account and it will transfer to the scheme. Then we have a third option, SWP, systematic withdrawal plan. So in systematic withdrawal plan, this plan is basically dedicated for the people who are looking for a regular income. Okay, so for them, this SWP is applicable. They have to invest in lump sum. Let's say they are investing, they have invested let's say 10 lakh rupees and they are withdrawing 10,000 rupees per month. So every month they will get a 10,000 rupees in their bank account. Now the four categories or four styles basically STP, systematic transfer plan. Now this systematic transfer plan, we are transferring funds from one scheme to other scheme. Okay, now this can be used in two cases. The first case is basically profit booking. Second case is averaging. So first we will consider profit booking. So let's say you are already invested into a equity scheme and now you think that the market may reverse or may come down in next few months. So in this case, you will start booking partial profit. Okay, but you will not withdraw that money in your bank account. You will just transfer certain amount of money on a particular frequency. Okay, this frequency can be daily, weekly, monthly, okay, or even sometimes fortnightly. You are transferring funds from one scheme to other scheme. So let's say equity to date. Okay, so here we are whenever we are transferring funds from the equity to date, we are basically booking the profit and they are safeguarding that amount of money because you are parking in date funds. Now this again the debt funds are like liquid funds where the risk is very low. So your capital will not be get hampered. In second case is basically averaging. So when the market is dicey, so you never know what is going to happen with the market, whether it is going up or going down. But you are sure in the long run, let's say 1 year down the line or 2 year down the line, the market will be at upside. But right now there will be huge fluctuations, or you are not confirmed about the direction of the market. So in that case, you park huge amount of money into liquid schemes or debt schemes, and then you are gradually transferring from liquid funds to or debt funds to equity schemes on again daily basis, weekly basis, or monthly basis. So you are basically averaging for that particular period. So after 1 year, 2 year, when the market start rising, you will get benefit. Okay. So these are the four styles. Whenever you invest into schemes, The form of the application form is having two options, whether it is a direct plan or a regular plan. If you are directly investing through AMC, okay, from AMC office or AMC's website, then you will always go with the direct plan. But if you are purchasing or investing through any intermediary like a broker, distributors, or a bank or any wealth management companies, then you have to go with the regular plan. Okay. Again, you have to select some of the options like growth or dividend. The growth is nothing but there is a capital appreciation of your unit. Okay, the NAV will get appreciated in growth. But in dividend, frequently the dividend is issued by the mutual funds or mutual fund schemes. Now again, this dividend having the two options, as on shares when the dividend get declared, the dividend get credited your bank account, right? But in mutual funds, you have an option either to get a dividend in your bank account or you can reinvest that dividend. So you have to select, even if you select the dividend option, you have to select either of these two. It is IDCW. IDCW stands for income distribution from capital withdrawal or dividend reinvestment. So if you select IDCW, so whatever the dividend get declared, it will get credited to your bank account. However, if you select a dividend reinvestment, then this dividend will again reinvested at new NAV or ex-dividend NAV in your, okay. Now different types of forms available in mutual fund. That is, first is a common application form. So if you are investing in mutual fund scheme first time, then you have to use this common application form where you have to fill all your KYC details along with which type of scheme you are investing, all the options like uh, a direct plan or a regular plan or growth or dividend. So you have to select those options, investment amount, and if you are paying through check or DD or you are basically through online payment, so you have to mention all these details. You also have to fill the nominee. Okay, so various details are basically you have to justify or basically declare. Then if you want to start SIP, then along with the common application form, you also have to fill a SIP registration form where you have to mention how much amount of SIP you want to start, what will be the payment frequency, monthly or quarterly, or even there are some yearly frequencies also available. Apart from that, you have to mention how many years you want to continue with this SIP. Let's say 1 year, 3 years, 5 years, or till cancellation. Okay, or there is a default option also available up to 31st December 2099. Okay, then there is a one-time mandate you have to give. Now this OTM basically gives the right or basically right to the AMC that they will debit a certain amount of money up to certain limit. Okay, mentioned on this one-time mandate on request. Okay, so there is no need to do net banking or give check. Once you give this OTM and his OTM is registered with the bank, then only by giving the instruction to the AMC, you can invest up to the maximum limit mentioned on your one-time mandate. So for example, let's say if you have mentioned 5 lakh rupees as your OTM mandate limit, then up to 5 lakh rupees you can invest without any check or net banking. You have to just give instruction to the AMC and automatically the amount will get invested. Okay. So similarly, you will have a SWP and STP registration forms, some common transaction slip where you have to withdraw funds or you want to add or additional purchase. Okay. There are some other forms where you can modify your information. Okay, where non-transaction forms where you can modify your bank account details, you can modify the nominee, you can modify your uh, contact details, okay, like email ID, mobile number. You can also change your address. So there are non-transaction forms also available. Now let's come to the net asset value. Now net asset value is nothing but the price of the mutual fund units and it is declared on daily basis. So this is certain calculations for it. Okay. So basically, net asset value is calculated on daily basis on the basis of how much amount of interest income they have received on that particular day, how much amount of dividend income, any realized capital gains means if they have sold any particular shares at profit, and if any valuation gains. And they also subtract some realized capital losses if they have sold any particular shares or securities at losses, some valuation losses, and scheme expenses. Now, the scheme expenses includes all the type of expenses like commission paid, uh, recurring expenses like administrative expenses, brokerages, taxes. Okay, so all together we call them as scheme expenses. So when we arrive at this, for example, let's say initial uh, we have a 150 rupees in stocks, 67 crores in bonds. So all together we have a different amount of money, and when we add all these things, we are arriving at the NAV. Okay. Again, the mark to market, and it is very important. Every day, all the securities of the schemes had to be marked to market, and after that, the NAV is basically calculated. Then we have a total expenses in mutual funds, or we also called it as total expense ratio, which includes investment and advisory fees and recurring expenses. So these are the different types of recurring expenses like marketing and selling expenses, brokerage, audit fees, custodian fees, and many more. So there is a dedicated TR limit is basically set by the SEBI for all the mutual fund companies and on the basis of their types. So all the equity schemes you can see in the second column up to if the asset size of the particular scheme or AUM is up to 500 crores, or basically we can say the first 500 crores the TR is applicable 2.25, next 250 2% and so on. So similarly for debt scheme you can see that 2% TR for up to 500 crores, more than 500 up to 250 crores 1.75 and so on. So we can say the TR is basically calculated on the basis of the AUM of the mutual fund scheme. So as the AUM grows, the TRs comes down. Okay. Now performance parameters of the equity mutual funds. So there are these 10, 11 parameters I have mentioned, like asset mix. So in equity mutual fund, what kind of asset? So of course, it's an equity asset, but again, what type of equity? Whether they are investing into large cap, mid cap, small cap, or a multi cap, or any dedicated sector, or the basis of theme. So we should know in which type of asset. And again, further they are diversifying into any particular subtypes like industries or sectors. Then the NAV, but again, NAV cannot be major performance parameters because if you find the new schemes, the NAV will be at lower side. But if you find the old scheme more than 10, 15 years old, you'll find the NAV at higher side. So you cannot judge on the basis of the NAV. But yes, on the basis of return of investment or return on mutual funds like CAGR, IRR, or XIRR of the mutual funds scheme, you can predict what will be the future performance. Okay, it's not a guaranteed, but yes, you can uh, predict this particular scheme can give this much amount of return. Okay. Again, the gross dividend yield, standard deviation, again the risk associated with the scheme, beta, alpha. Okay, so these are the parameters for equity mutual funds. Whereas the parameters for debt mutual fund are again some of the parameters are common, but the average maturity, modified duration, the portfolio yield. So these are the uh, performance parameters for debt mutual fund. Okay. So whenever you select or compare the schemes, you have to compare on the basis of these parameters. Then only take a appropriate decision in which scheme is suitable for you or how much risk is you are basically you can able to bear. And again, it is depends on how many or holding period, how many years, how many months you are going to be invested in that particular scheme. Okay, so that's it from my side. Thank you. If you want to know more, please contact me. Okay, the link, I'm giving my details in the below mentioned in the description of the YouTube channel. Okay, thank you.